More often than not, when you have banks fail, it's due to credit losses. In other words, borrowers who have borrowed money from the bank fail to repay, which results in the bank getting into distress and eventually failing. The recent failure of Silicon Valley Bank was different. Silicon Valley Bank failed due to reasons other than credit losses. It failed due to changes in interest rates that we have had in the US over the past 12 months or so. Specifically, when interest rates go up, the prices of bonds go down. And banks such as Silicon Valley Bank, they hold billions of dollars of bonds. So you had a situation where the interest rates in the US went up, the value of these bonds came down, and therefore Silicon Valley Bank lost the confidence of its depositors. Eventually, there was distress, and then we all know what happened after that. Instances such as these are very good learning opportunities for students of finance. In this video, we have a learner who is going to help us estimate how big a move in interest rates it took for Silicon Valley Bank to get into distress. Being able to perform back of the envelope analysis and calculations is an essential skill for a trader or an investor. This is because when you're trading, the ability to process information quickly is essential to success.
Hi everyone. This month has been one of tremendous uncertainty for the global financial markets. Earlier this month, these events began with a US bank named Silvergate facing troubles because of its large exposure to the ailing crypto industry. Many of you must have heard and read about the Silicon Valley Bank failure, which followed after that. I am going to talk about particularly the trigger behind Silicon Valley Bank's failure. The trigger is really a very basic bond market principle. The failure of SVB is somewhat unique, as historically banks failed because they could not get back large proportion of what they lent out. But that isn't exactly what happened with SVB. Just a slight peek into the assets and liabilities SVB held on its books as of December 31st, 2022. Cash and cash equivalents of $13.8 billion, investment securities of $120 billion, and loans of $73.6 billion versus total deposits of $173 billion, of which $81 billion were demand deposits. So the event actually began with SVB announcing an equity issue of $2.25 billion, $2.25 billion, sorry, on March 8th. The press release for this issue also mentioned that the bank had to bear a loss of $1.8 billion on the sale of securities worth $21 billion. This happened because of rise in interest rates since the bank invested in these bonds, which led to a fall in price. And this phenomena we'll examine in further detail in just a minute. On the same day, one of SVB's largest depositors pulled all of its deposits from the bank. That combined with the news of bank's loss on its securities led to depositors rushing to withdraw close to $42 billion on March 9th. This amount was almost one-fourth of bank's total deposits. That is a classic bank run where the bank ran out of cash and liquid assets and couldn't meet all the withdrawal requirements. So let us go through a simple calculation to understand how interest rate increase in the US became the cause for SVB's failure. So here you see that let's assume a certain things to make the calculations a little easier. Let's assume that SVBs only invested in US 10-year Treasury bonds, zero coupon bonds, let's say, and the bonds were issued in 2022 itself. Figures will change slightly with the issue date, but the conclusion remains the same. And SVB bought the bonds 3 months back. Again, this is only for simplicity. We can assume that SVB bought the bonds 1 year ago, 6 months ago, 2 years ago. The figures will change. The conclusion remains the same. So let's start. So we know that SVB sold the bonds on 8th March 2023 for $21 billion, and the loss in bonds was $1.8 billion. So now we know the amount at which SVB bought those bonds, which is $21 billion plus 1.8. which is $22.8 billion, right? So now we know one thing that we've taken this data. Let's say the YTM on 10-year treasury bond, 10-year zero coupon treasury bond was around 3.99% on 8th of March 2023, right? So now, how do we calculate? We need to know, first of all, the number of bonds purchased and the price at which SVB sold its bonds. So how do we calculate the price? So for a zero coupon bond, there's only one cash on the maturity date, and that is the face value of the bond, which is 100. So, okay, so this is a 10-year bond, so 100 divided by 1 plus, we're discounting 100 by the YTN, and it's going to come after 10 years. So raised to the power 10. This is the present value of the bond, or in other words, the price of the bond, right? Now we have the price and we have the total amount, so we can calculate the number of bonds purchased, which is amount divided by price. So these are the number of bonds purchased by SVB and sold similarly. So on 3 months back, when SVB bought those bonds, the value was $22.8 billion. We want to know exactly what happened to the YTM and the price so that SVB faced this much loss, the loss of $1.8 billion. Okay. So given the amount at which SVB bought the bonds and the amount of number of bonds, we can calculate the price. So you see, bond prices went down by almost 5.8 billion, $5.8 throughout this during this period. Now we need to understand what exactly happened to the interest rate. Surely we know that basic bond market principle that I was talking about earlier, interest rates rise, price of the bond falls. Similarly, interest rate falls, price of the bond rises. So in this case, price of the bond has fallen from 73.4 to 67.6. So we are expecting a rise in the interest rates, right? So how do we calculate the YTM over here? Again, 100 is the terminal cash flow or cash flow on the maturity date, and that is a single cash flow, right? And we know the price. So this is the present value of the bond. To calculate YTM, we'll just do a bit of algebra. That's the maturity, that's the duration of the bond. There you go. So you have the YTM 3 months back was almost 60.14%, which means that the interest rates have risen during the period that SVB held those bonds. The interest rates have risen, must have risen by 0.85%, so that SVB the price of the bonds fell by $5.8 per bond, and therefore SVB had a loss of $1.8 billion. This concept, again, there's an underlying concept which we know as interest rate sensitivity. That is, how much would the price change with a 1 basis point change in the interest rate of the bond? So let's calculate that as well. What is the interest rate sensitivity in this case? So first of all, change in YTM in basis points. So 1 basis point is 0.01%. So here it's 0.85%, which we'll have. So the basis points is nothing but 85. Okay. And change in price is 5.795. So I'm just going to put the absolute number. Okay. Now, how do we calculate interest rate sensitivity? Is the change in price by the change in interest rate. So let's do that. Change in price divided by the change in interest rate. So you see, the interest rate sensitivity in this case would be 0.06818, or if you want to understand in simple terms, will be 6.8 cents per basis point. So every 0.1% change in interest rate would lead to a 6.8 cents change in the price of the bond. In this case, 0.1% increase in interest rates led to a 6.8%, 6.8 cents fall in the price of the bond. Thank you.